From 2000 to 2019, Germany's automotive landscape was on the rise, with around 3.3 million new vehicles registered each year. But with the outbreak of COVID-19, this industry hit a historic low in 2022. The new vehicle market plummeted by 26% and the used car market by 22%, a downturn even more severe than during the 2008 financial crisis. As we enter 2024, there are glimmers of recovery, but the road ahead is full of challenges. So what is really going on and why? And what does it mean for the future? Join me as I explain this complex development, backed by data of 23 years and expert opinion, analyzing the decline of combustion engines, the rise of e-mobility, and the impact of global demographic and macroeconomic shifts, as well as the changing preferences of the consumers and the entrance of Chinese OEMs into the market. Hey, just a quick note. A lot of effort and research went into making this video possible. If you find the content valuable afterwards, please make sure to like the video, subscribe to my channel, and probably share it. Being a small YouTuber, it's going to help me a lot. Thank you. So without further ado, let's start. In Germany, cars are a symbol of tradition, innovation, and national pride. And hence the iconic brands like Mercedes, BMW, Audi, Porsche, and Volkswagen are ingrained in the national identity. The automotive sector in Germany employs 775,000 people, or 1.9% of total workforce of Germany. That's like the entire population of a major city like Frankfurt or San Francisco. This sector contributes a staggering 509 billion euros annually to the economy. To put that into perspective, that's 89% more than the Germany's second largest industry. It's a clear indicator that this industry is the driving force of the economy. But as we are about to see, even the mightiest sector faces its own set of challenges. Looking at the data of 23 years for the new and used vehicles, we can observe how global crisis affected the Germany's automotive sector. Annually, the market sees an average of 3.2 million new and 6.7 million used vehicle registrations. The year 2000 was dominated by gasoline cars, which comprised 70% of new sales. However, by 2007, as the diesel engine's technology evolved, becoming more efficient, the gap narrowed massively and brought the gasoline-diesel ratio to 52 and 48% respectively. This balance was maintained until 2016 with one notable exception, the extraordinary year of 2009. In response to the 2008 financial crisis and declining automotive market, the German government launched an ambitious 5 billion euros Abwrackprämie, a car scrapping incentive scheme, where 2,500 euros was offered to owners for scrapping a car over 9 years old in exchange for a new one. This move sparked a sales boom. 2 million vehicles benefited directly from it, and hence a peak of 3.8 million new vehicles in a single year was reached, a peak that remains unbeaten in 2 decades. However, 2016 marked a turning point for diesel engines, triggered by Volkswagen's infamous Dieselgate scandal.
German prosecutors have charged Volkswagen's former CEO, Martin Winterkorn, with serious fraud.
The company admits it rigged 11 million vehicles worldwide to cheat on emissions tests.
This includes 5 million Volkswagen cars, 2.1 million Audis, 1.8 million Volkswagen trucks, 1.2 million of the Czech Republic brand Skoda, and 700,000 Spanish Seats.
The revelation that Volkswagen has been using cheat devices in their diesel engines, due to which they could perform in an eco-friendly manner on the bench tests, but once on the road, they emitted 40 times more NOx than the legal limit. This scandal severely damaged public trust in diesel, leading to a rapid decline in their popularity. As a result, many OEMs re-evaluated their business plans and ultimately reduced their R&D investment in diesel technology. 2019 marked a tipping point in the propulsion mix. Internal combustion engine vehicles, which dominated the market with 91% market share for the new vehicles, fell to the historic low of 52% by 2023. In contrast, hybrid and battery electric vehicles saw remarkable growth, with battery electric vehicles surpassing the diesel in market share, a significant milestone. However, plug-in hybrid electric vehicles, after their initial success, lost foothold following the subsidy cuts. Although it was sold as a common ground between hybrids and battery electric vehicles, however, people after getting the subsidies usually were driving it like a hybrid that is running on fuel. The rise of e-mobility has opened new doors in the German market for Chinese OEMs, a development that has significantly rattled German and other OEMs. The Chinese entrants offer competitive value propositions that European brands are currently struggling to match. This emerging competition has prompted the European Union to consider implementing stricter regulations, whereas there are some countries that are even taking the subsidies for these new entrants to protect the local market. This move is likely to heighten tensions and could escalate further in the future, especially considering the reliance of German OEMs on the huge Chinese market. The response from China against these European measures remains a key aspect to monitor in the future. Now let's look on the downfall of the automotive sector, and COVID-19's impact on it cannot be overstated. To shed light on this topic, I've invited Dr. Schüler-Hainsch from ZMI Consulting, an expert with a rich background in automotive innovation working at Daimler, as well as my esteemed former professor.
So the situation was that factories had to close down, dealerships have been closed, so people even haven't been able to buy a car during the lockdown phases. Also, in the phases where it was open again, there have been big disruptions in the supply chain, because then in some other country where important parts have been produced, there have been a lockdown to another time. So the whole system was strongly influenced by that. Big other aspect is still disturbances in the supply chain, especially with the automotive chips, where we had a shortage in 21 and 22, and we still have. The main reason for that is that with the corona crisis and the drop in the automotive market, and on the other hand, people sitting at home, working in home office, the consumer electronics market has been grown that time. The demand for chips shifted from automotive stronger to consumer electronics.
During this turbulent period, I witnessed this material shortage firsthand while working at a top tier 1 automotive supplier. It was almost surreal to witness shortage of essential materials like steel and aluminum, accompanied by their skyrocketing prices, and despite these high costs, securing sufficient supply remained a challenge. This illustrates the pandemic's far-reaching effects on the automotive supply chain. Along with COVID-19 pandemic, the nation's macroeconomic environment has played a vital role in shrinking the automotive sector. For over 2 decades, the inflation in Germany was relatively tame, averaging around 1% and seldom peaking above 2.3%. However, the landscape shifted dramatically with the advent of COVID-19 and Russia-Ukraine conflict, as the inflation skyrocketed to 6.9%. This drastic increase in living costs outpaced the wage growth, significantly impacting consumer spending power. Another explanation for the downfall is the change of production strategies.
For example, if we look to the German automotive industry, with a lower number of chips, they repositioned and reprioritized their production planning and product planning, and use the chips more for their premium cars because the margin was bigger.
To perceive its impact, let's look at the affordability of a new and used car in Germany. Germany's workforce consists of 45.8 million people, and nearly 90% of them are employed. The yearly gross income excluding taxes increased from roughly 30,000 to 49,000 euros during the last 23 years, but so did the price of new as well as the used car. From 2000 to 2019, new cars cost about 67% of the average income, and the used car around 24%. But now, the new car costs nearly 87% and used car nearly 38% of the average income. This means that the new cars are 27% and the used cars staggering 50% more expensive than they were just 4 years ago. This stark increase in the vehicle cost is pushing away the private car buyer. For the last part of the video, let's examine the key factors and indicators that will shape the road to recovery for Germany's automotive market.
Car ownership in Germany, so the rates of how many cars per 1,000 inhabitants, they did not go down. They are even in 2022 a bit higher than they have been in 2019.
This indicates that the total number of vehicles has been steadily increasing. Looking at the number of passenger cars in Germany for the last 16 years, this number has grown from 41 to 49 million. Such growth suggests there is resilience in the market and is indeed a positive sign. On the other hand, another notable trend is the rising average lifespan of a vehicle. In the last 23 years, cars in Germany have gone from an average age of 7.1 to 10 years. This increase can be primarily attributed to the advancement in automotive technology and reliability. Looking at the data from 2000 to 2019, the number of maintenance visits have gone down by 17%, whereas the number of replacement of wear and tear components has significantly gone down by 37%. Due to this, people are happy to stick around with their old cars. A key trend reshaping Germany's automotive landscape is the gradual demographic shift. Data from 1950 to 2013 shows a stark decline in the birth rate, from 2.5 to a stable rate of 1.4 since 1990. However, the last 10 years have witnessed a slight increase to 1.5, still below the 2.1 replacement rate needed for a stable population without considering migration and mortality changes. This trend towards an aging population could lead to a future with fewer high-income earners. Should this trajectory of an aging population continue, we may see stagnation in the new vehicle registration in the coming decades, eventually giving way to a decline. Battery electric vehicles are the future in Germany, and their growth is a crucial factor in the industry's overall success. However, after 4 years of continuous growth, we observed a slowdown in 2023. This change can be attributed to the removal of subsidies and the high initial cost of purchasing a battery electric vehicle. But a new challenge has also surfaced since 2022, the rising cost of charging at a public charger, which is a direct consequence of the Russia-Ukraine conflict. In a period of 21 years, the energy prices in Germany were quite stable and increased from 14 to 32 cents per kilowatt hour. However, in 2022, the price increased from 32 to 52 cents per kilowatt hour. That is 62% increase within a single year. This price increase had a huge impact on the majority of the people who rely on public DC fast chargers, as the cost to charge an electric vehicle to drive 100 kilometers is now roughly equivalent of fueling a gasoline vehicle for 100 kilometers. Indeed, I've made a very simple calculation without considering the insurance, the depreciation cost, the repair cost, but it is a significant indicator of the current situation. Another small factor in the automotive market is the balance between the private and company cars. Before 2008 financial crash, company car represented 55% of new vehicle registrations. This figure has steadily increased, reaching to 67% by 2023. Although this trend may seem sustainable, it has its own risks. The growing popularity of remote and home office, as well as companies' focus on carbon neutrality, could disrupt this balance. It's a very simple concept. As people are going to use more and more remote calls and avoid face-to-face meetings, that means the number of kilometers driven per year are also going to reduce, which essentially means less and less company cars, having a direct impact. Finally, the future of automotive sector is also dependent on the new mobility concepts.
There is one driver which we have expected in the past to be much stronger, is the idea of new mobility concept with car sharing, carpooling, and all that has the potential to reduce the need for new cars. What we see currently is that it, at least until now, not happened in that way. Car manufacturers like Daimler and BMW, they stepped back from that business, sold it partly Volkswagen.
To conclude the video, what can be expected in terms of recovery, Dr. Schüler-Hainsch summarized as follows.
I would expect, but I cannot prove it, that the numbers will be somewhere in between where we are currently and where we have been in 2019.
Reflecting on the 2008 financial crisis, we see that the used car market took 5 years to rebound, while the new vehicle sales took nearly a decade. As of 2023, we are witnessing early signs of stability and recovery. Projecting from the past trends, it is plausible by 2027 the used car market might approach its previous numbers, whereas by 2030, the new vehicle sales probably not 100%, but will edge closer to 2019 figures. If you've made this far in the video, thank you so much for watching the video. If you have gained insights from this video, please support my efforts by liking the video, subscribing to my channel, and probably sharing it. And if you have any questions, comments, and feedback, please write down in the comment section. I will make sure to reply to all of them. Thank you so much. Take care. Bye-bye.